Welcome to Pete's Property Podcast, brought to you by Buyers and hosted by Pete Wargent, buyer's agent, finance and real estate expert, and all-round property guru, plus published author. Join Pete for 30 minutes as he chats all things property with a new guest each week. Learn practical tips from the movers and shakers in the property industry and well-known personalities sharing their property journeys.
G'day, welcome to this week's episode of the Pete Wargent Property Pod. I'm thrilled today to invite back a very special guest onto the podcast. It's none other than Michael Yardney, Australia's most experienced and well-known property educator and the founder of Metropole Property Group. Michael, welcome.
Thank you, Pete. And I'm glad that even though I've been here a few times, I'm still a special guest. That's an honour.
Yeah, so I was called out recently for having the same introduction every week. So I'm trying to mix it up a little bit. But I thought this week it would be great to get you back on as somebody who's been around the traps and seen a few cycles, because there's a lot going on at the moment. We've just had a federal election. We've got interest rates going up for the first time in many years and inflation. So I thought it would be useful to get somebody on who's seen all these things a few times before. Let's start at the beginning, shall we? Federal election. I think this time around the polls seemed to get it right. And it was looking a bit hairy for Labor early in the night, but obviously in the end they got the majority. So a Labor win, what do you think that might mean for the economy and housing markets? Because you've seen a few governments come and go over the years. Does it make any difference to the housing market? Who's in power?
Well, let's look back at my history of investment. And if I look back, I think I enjoyed the greatest growth over the last couple of years under a coalition government when we enjoyed that once-in-a-generation property boom. And this was, of course, based on what I've now got a very, very substantial property portfolio that I've built over, 5 decades. So I guess there's a lesson in that in itself, Pete. Invest for the long term, hold for the long term, because your profits compound. However, when I first started investing, Pete, it was in the 1970s, and the Labor Party came in. Gough Whitlam came into power. Inflation was very high. And I again experienced tremendous growth in my assets. Now, of course, at that time, I was young. I knew nothing about it. I didn't know about the economy or interest rates or the interplay of all these factors. But Pete, most people don't recognise in the 70s, we had very high inflation. It peaked at around 18%, almost 18% in 1975. That was for a short time. And Pete, in those days, I was thrilled when my mortgage rate was below 10%. So again, we had higher inflation than the mortgage rate, a bit like now. But then we ran into an inflationary wages growth, rising interest rate spiral that eventually led to a recession in the early 80s. A lot of people know about the recession of the 90s, the recession we had to have, but there was one in the 80s. And one of my concerns, Peter, at the moment with this new government is if we're not careful, that could happen again, because the new government's encouraging minimum wage increases. And so if wages go up, people are going to spend more. That's good for the economy, but it's inflationary. Some business owners are not going to be able to afford it, so they're going to put up prices, which is inflationary. Both those things will make interest rates rise. We're in for some interesting times, Pete.
I guess this is the thing with the change of government, and it's a challenging time anyway for the economy. We're coming out of the COVID lockdowns and the borders are reopening. Now, last time around, Labor had some controversial tax policies, some of which directly impacted housing, but not so much this time around. So what do you see as potential policy changes? I think one of the things that's going to be a key factor over the coming few months is, well, what will happen about immigration? Because we've got a massive skill shortage. And under the federal budget, it was kind of assumed that immigration would get back to about 235,000 by next year, which points to population growth of, 350,000, maybe 400, so strong, in other words. So do you think the Labor Party would be pro-migration? I've heard some talk about things like parent visas and other schemes to sort of pump up the population.
Oh, I think they will be. But just getting back to the their property policies. They only came in the last couple of weeks of the election, didn't they? For the first bit of the election, no one really talked about property because this affordability issue is a problem because there's no easy way of solving it, and no one wants to dampen the property markets and drop property values. So with regard to property, the Labor Party fiddled around the edges. They got 10,000 first home owner shared equity scheme. It actually sounds like a good idea, but they're also going to help 10,000 regional first home buyers. And yes, they're going to build 6,000 social and affordable houses a year. That's not enough. All these policies, though, Pete, are going to increase demand. They're not increasing supply. They're not addressing the supply problem. So in my mind, they're going to underpin values, particularly in the lower price bracket areas. And you can see what's happening. Somebody's suddenly going to get a $50,000, $40,000 bonus. They can borrow more because the government's putting some money in. And you can see some vendors saying, hey, honey, we just sold our property for $50,000 more than we thought we would because the first home buyer bought it. It's like those old grants a while ago. They're an established home buyer grant. So I can't see them helping the affordability issue, Pete.
Yes, interesting you mentioned the price quartiles there, because it feels a little bit like 2017, I think it was, all over again, where interest rates have been tightened a little bit. And then suddenly some of those properties at the top end, in the top quartile or the premium end of the market, the ones that might have gone for, 6 or 7 million maybe a couple of months ago, suddenly going for 5 or 6. And there's been a sharp sort of change in sentiment at the top end of the market, which is mainly, I guess, houses in Sydney and Melbourne. But as you said, at the bottom end of the market, or the sort of median prices and below, maybe not so much change.
Sure. So the upper end led the property boom. It always does. And it starts to lead the downturn as well. So that's not unusual. So it'll be interesting to see. But I think what's going to affect the property markets more is going to be consumer confidence, because at the moment, everyone's a bit nervous. Buyers are nervous. They're sitting back at the moment. Vendors are nervous. They're not putting their properties on the market. And if they're going to auction, Pete, they're selling before because they're a bit scared to go to auction, or they're withdrawing their properties. So it'll be interesting to see how interest rates and the scare of rising rates and falling property values affects our markets, because in some ways it's a self-fulfilling prophecy, isn't it? If everyone says there's a property market's going to crash and people sit by the wayside, well, waiting on the sidelines, it's not conducive to rising values, is it?
No, it's a bit of sort of game theory, isn't it? It's you've got to buyers start sitting on the sidelines and wondering how much of a discount might they get by waiting, and then at some point the cycle turns.
Yep.
You said that you started investing back in the 70s, so I guess you've seen 5 decades of cycles come and go. What is it in your experience that makes property prices go up over time? Because if I look back at prices in the 1970s, they're phenomenally cheap compared to today. So what is it that actually drives those property prices over time?
Well, in the short term, Pete, it's interest rates. Cheap rates make it easier to borrow. It gives you more affordability. That's what happened over the last couple of years with cheap interest rates. Of course, it's also got to do with supply and demand. Now, this includes population growth. People talk about population growth. It actually is a bit more family formation, because if somebody has a baby, it increases the population, but they don't need another house. So supply and demand, family formation, and also the supply of dwellings. And that also has to do with the availability and the cost of land, the cost of construction. They're supply side factors that affect the housing market. And also, I guess it's got to do with the affordability of rental housing. So supply and demand, interest rates, access to credit's important. It's not as much interest rates. Lowish interest rates drive the market, but credit squeezes slow the market down. The economic climate's another factor that drives our property markets. Inflation, employment levels, if you feel comfortable in your job, if you feel secure, and consumer confidence. I remember there were times in the cycles when all the fundamentals looked good, but people were nervous, so they wouldn't make big decisions. And I guess the other thing that drives in the short term, Pete, is government incentives, like we've experienced recently. Investor appetite, that's another big one. Local and foreign investors. There was a period when foreign investors drove certain parts of our market. They're not there now. But in the long term, there are very different factors. In my mind, the big picture, that's what we've got to concentrate on rather than the short-term ups and downs, Pete. Demography. A lot of people say population growth, but it's really more demographics, household formation, as I said, how many of us there are, how we want to live, where we want to live. So I believe demographics is one of the most important factors in what's going to drive our markets. For example, the changes in post-COVID, the work from home means how we want to live, where we want to live, the sort of properties we want to live in will be different. So one thing, the two big drivers are demography and the wealth of the nation. In other words, if you can afford to pay more, if there's a positive relationship between household income and housing demand. Of course, it's real income, so you've got to make money in these inflationary times.
Yeah, so as you said, in the short term, lots of different sort of micro and macro factors, and confidence plays a big role. But in the longer term, demography or demographics and the wealth of the nation, the two big drivers. Well, let's take a look at those in turn then. Let's start with the demographics. So I saw the last intergenerational report. There's been a real slowdown, of course. There's been almost a pause in immigration through the pandemic. But the population is still expected to go from about 25 million or so today to around 40 million by 2060. And I think if population growth goes back to around 1.5%, that's about 400,000 a year. So look, it might be a bit less when things play out, but that's still, you're still talking about adding a city the size of Canberra every year. And I think the other thing is in Australia, most Aussies live in the cities, and city living is expensive everywhere in the world. And we've got more city dwellers than almost anywhere else in the developed world. So I guess, there's some big positive drivers there demographically, lots of younger migrants coming in. And I think increasingly more Asian migration, most of which will go to Sydney and Melbourne.
Sure. In fact, between now and the middle of this century, we're going to add another Melbourne, Sydney and Brisbane in population, as you say, another Canberra every year. And it's not just where they're going to live, but also the infrastructure that has to go with it, Pete. So first of all, where they're going to live, as you say, the majority are going to want to live where the jobs are. And as we've already started to say, the government's going to introduce skilled migration to help the shortage of jobs at the moment. So no use sending them to where the jobs aren't. You've got to send them to where the jobs are. And then it's also how they're going to live and how we're going to fit all those places in, because it's suggested that for every dwelling at the moment, between now and the middle of the century, for every 3 dwellings, we're going to have to build 1 more. That makes a huge difference. And so that means we're going to have a lot more medium and high density accommodation. But for every 1,000 people, they're going to have children. They're going to need schools. They're going to need daycare. For the older people, we're going to need nursing homes or other care as well. So it's not just the infrastructure that most people think about. I'm stuck on the roads listening to Pete's podcast because the car's so slow. It's actually social infrastructure, such as schools. Where do you fit in another school? Where's the grounds for the schools? Now, where are you going to put the hospitals and the nursing homes? So there's some huge town planning issues for our government ahead, Pete.
Yeah, and it comes around sooner than you think. I mean, if you're looking at population growth in that kind of range, I mean, Sydney and Melbourne will be going from 5.5 to 7.5 million pretty quickly, 20 years or a bit longer. And that's a lot of people to squeeze in when you think about all the infrastructure, like the schools and the transport. Yeah, I mean, we've seen Sydney and Melbourne change a lot over the past 20, 30 years. And I guess the same will be true again over the next decade or two. I guess that's on the demographics side. And as you said, the way in which people live is changing a little bit as well. On the household wealth side of the equation, I recently took a look at some of the numbers, and it seems that household wealth seems to roughly, double every decade or so. So 30 years ago in Australia, it was about 1.5 trillion. And then 20 years ago, 3 trillion. And then in 2011, it was just over 6.3. And then last year up to 14.7 trillion. So that's over $500,000 Aussie dollars per person. So arguably the wealthiest or one of the very wealthiest nations on earth. Now, I guess this is where compounding is quite counterintuitive, because if you follow that pattern, that suggests 30 trillion in a decade's time, and then 60, and then 100, which is very hard to sort of compute in today's dollars terms. Obviously, the housing market is a big part of that.
Well, the housing market's a huge part of Australians' wealth. And I think it's really important to understand the wealth effect, because in every society, housing is generally considered a major store of wealth. And in Australia, it accounts for much more than half people's total wealth. So their wealth is partly related to their superannuation, a forced form of savings, and the share market in general there. But owner-occupiers and property investors, they feel wealthier when they see that their house prices rise. And that wealth effect leads to extra consumption, extra expenditure. It makes the wheels of industry grow around it, keeps the economy going. And that leads to economic growth. And that supports more rising house prices. I guess it's a self-reinforcing cycle. And that's part of what's contributed to this recent house price cycle in Australia, because we've felt wealthier, we were given more money, money was cheaper. But I think, Pete, those lobbying for more affordable housing forget the wealth effect of rising housing. Now, I'm not talking about the importance of the building sector, because that's an important part. There's all the flow-on effects. When people buy a house, they buy carpets and curtains and refrigerators. But the increased property values have a positive effect on GDP, on an economy, because when people feel wealthier, they spend more. And I remember reading a paper from the Reserve Bank, and I know what I'm going to say is going to annoy some listeners, but the Reserve Bank published a range of research that calculates the benefit of the change of wealth due to house prices increasing. And they've unsurprisingly found that changes in household wealth due to changes in house prices impact the growth of household consumption. In other words, as I said, people spend more. In simple terms, they found that when wealth increases, as house prices rise, spending grows, helps the economy. And it's the opposite, Pete. If house prices were to fall, spending growth would slow. And so making properties more affordable isn't going to help anybody. Banks aren't going to lend as freely if they're worried about house prices falling. So we should be thankful. It's intuitive that if somebody feels they're feeling wealthier, it's good for the whole economy. So let's build everybody up to that level rather than pull people down to the lowest common denominator.
Yeah, you can see why governments tend to like housing prices on going up through the cycles, and hence the support for first home buyers. The market's worth best part of 10 trillion today, and we've only got 2.5 trillion in debt as a nation. So I guess that represents massive generational wealth in Sydney and Melbourne, which underpins the market. I guess prices never seem to fall very far before people start deploying those funds again. And I think, unlike where I'm from in the UK with its 40% inheritance tax, Australia just doesn't have that. So the wealth gets passed down to the next generation and the next generation, and the wealth just keeps on building over time. I don't know whether governments will ever have the balls to tackle inheritance tax, but not anytime soon by the looks of it. You mentioned the challenge of supplying the housing market. Now, I guess we've often said on our podcast that we've got an undersupply of the right property types in the right locations, and we seem to be building in flood zones and the wrong types of property. But recently, land prices have risen a lot, but construction costs have really soared. And I know you guys at Metropole do developments.
I actually have a construction company that's involved in 8 development projects at the moment for clients and one for myself. So I fully understand, yes, they have soared. Who would have thought that in Australia, with all the trees, we get our timber from overseas? Who would have thought that in Australia, when we got iron ore coming out of the ground, we've got to have a shortage of those things? So construction costs have gone up considerably, Pete.
Do you want to save on buyer's agent fees? You could save thousands with Buyers Buyers. As Australia's most extensive network of buyer's agents, we can lock in highly competitive prices. Plus, our national network of buyer's agents are some of the best in the business. So get the Buyers Buyers advantage and talk to us today. Call 1800 975 051 or visit buyersbuyers.com.au.
So I guess we keep reading in the news about the various challenge of developers, and keep also seeing that some of the big tower blocks that were planned, places like the Gold Coast and some of the big city towers being shelved for the next cycle. So it seems that building approvals are on the way down with interest rates rising and construction costs so high. It's going to be a struggle to supply the market. Vacancy rates for rentals are already down to about 1%, which is the lowest in a decade and a half. It looks to me, just broadly, immigration's rising, construction is struggling. I mean, where is everybody going to live over the next decade? Because it seems to be a major challenge.
Well, it's a challenge for a number of reasons, including that we've got smaller households in general. People are being a bit more cautious about living in shared houses. There's also the millennials moving from apartments into homes. But there's currently, as you say, a huge shortage of rental properties, both houses and apartments, and there's intense competition for that. So depending upon whose figures you look at, Dr. Andrew Wilson's figures suggest that Sydney house rents went up 25% in the last year alone, and overall national house rents have gone up 16.8%. Now, let's be fair, for a couple of years, house rents didn't go up much at all, but apartment rents have moved up as well, as you say. And I think that's a combination of, well, like we always say, supply and demand, strong competition, but supply is limited at the moment. And I know you asked about how we're going to supply accommodation in general, but if we look in the short term in the rental markets, it's actually limited at the moment, Pete, because back in 2017, APRA restricted funding to investors, meaning there were fewer investors, less rental accommodation. And then, interestingly, during the pandemic, the last couple of years, many investors sold up. We manage over $2 billion worth of assets for clients in our rent roll, managing property in Melbourne, Sydney and Brisbane for clients. And many of them sold up. And when they tell the property manager, oh, we're about to sell our property, they say, hey, do you want to speak to a property strategist? And they say, no. Look, the local estate agent rang me and he's got a buyer for my property. I'm going to sell it. Of course they had buyers, but people were selling up, even though the property did exactly what it was meant to do, go up in value for them, Pete. And what happened was, in general, they were selling to owner-occupiers. So there are fewer rental stock on the market. And all those properties that were on Airbnb that went to the general rental stock, they're back on Airbnb again because tourists are back, local and overseas. So there's a huge undersupply in the short term. And I can't see any relief ahead because, as you correctly said, at the moment, there's a mixture of steep costs, price increases, interest rate hikes at a time that our housing market's entering a correction phase. So a lot of the apartment complexes on the drawing board, they're not going to come out of the ground this time round. So how on earth are we going to supply rental accommodation or owner-occupier accommodation? And that just means that despite us now having a slower time in the property markets, that's got to underpin property values because people have to live somewhere, Pete.
Yeah, and well, you mentioned the rent in Sydney for houses up 25% over the year. And I think that just reflects more broadly inflation, which is something obviously in the 1970s, as you mentioned, was a huge factor in the economy. So if you've got rents rising at 10, 20%, headline inflation is already over 5%. And I guess now heading higher with the Ukraine war impact on things like food and energy prices, power and fuel heading up. So I guess the headline inflation rate could get to 7 or 8 pretty easily. So interest rates will no doubt rise from here. But I suppose the other side of that is that incomes are going to rise as well. We've got the minimum wage increase of 5% potentially. But also some of those professional careers, the STEM careers, have got very high earning power in Australia and profits are at a record high. I'm interested to get your insight. So you invested through the 1970s when we had rocketing inflation and wage growth. Property investors obviously like to hedge against inflation. So how does inflation work in terms of the housing market, the inflating away debt and so on?
Well, inflation is, in reality, how much your money can spend. It's so it costs more to buy a McDonald's hamburger today than it did 10 years ago, or a bottle of Coke. In fact, I saw something on Instagram today where you could buy chicken in Woolworths in 1973 for $1. And so it actually means that you can't buy as much with your money, so you have to earn more. Also, inflation is the friend of people who own certain sorts of assets, and it's the enemy of people who have cash in the bank, because cash just doesn't buy as much. Savings just doesn't buy as much a couple of years down the track. So in the 70s, I had no idea about all these sort of things. I was still a student. I was still learning. I had my first job, and there wasn't as much information on the internet. So basically, I bought a property and it was dumb luck, and it went up in value, and the rent went up in value that much that I could actually buy another property. And then we actually ran into a recession, as I said. So I'm not sure how rising interest rates are going to slow inflation at the moment, when inflation isn't due to extra demand. It's actually coming from the supply side at the moment, isn't it, Pete, with the Ukraine war impacting food and energy prices. So unless the Reserve Bank pushes up interest rates that much, sort of puts a sledgehammer on our economy, what's going to slow inflation down this time around?
Yeah, well, I think, as you said, I mean, if you've got inflation at 7 or 8%, the Reserve Bank basically has to increase interest rates, whether it wants to or not. It would be a bad look if they didn't. But as you pointed out there, a lot of the problems have been on the supply side, and the Labour government could introduce things like a fuel excise cut, or policies to reduce power prices in the short term. Normally, supply rights itself over time, but there's a lot of uncertainty. Things like lockdowns in China and the Ukraine war could take some time, and this is all coming off the back of the COVID shutdown. So it's kind of a triple whammy in terms of the impacts.
So I didn't answer your question about how I'm protecting myself, or how investors can, which I will. And I guess it's owning the right sort of property, because certain properties are more likely to be in continuous strong demand. So property values will drop a bit, but for property values to crash, Pete, people have to sell up and have nobody there to buy the properties, and property prices will free fall. That's unlikely to happen, because everyone who wants a job's got a job. And as long as people are employed, they'd rather eat Maggi noodles than sell up their home. But if you own at the high end of the market, as we've already said, that's more volatile. The lower segment, where people have bought and they've borrowed to the hilt, the first home buyers, they're 1 week away from broke. They're also the areas that are more likely to suffer during difficult times. If you buy the right sort of property with high land to asset ratio, where you're not paying a premium to new developers, and if you maybe manufacture some growth and add value, all that helps as well. But people ask me, what am I doing? What's going to happen? It's a common question I'm asked. And so what I'd like to maybe say is that I have expectations rather than forecasts. And so I've been disappointing the media who's telling me what's going to happen, because I tend to say something like, a lot's going to happen over the next decade, but I don't make forecasts. Instead, I have expectations. And Pete, there's a big difference between forecasts and expectations. I expect there's going to be another recession in the next decade, but I don't know when that's going to happen. I expect the property market's going to flounder for a while, property prices will tumble, and then it'll boom again. But I don't know when that's going to happen. I expect some of my investments won't work as well as others, but I'm not even sure which ones. I expect interest rates are going to rise, but I don't know for how long or how much. Maybe even one day there's going to be another world financial crisis, but I've got no idea when that's going to come. But Pete, these aren't contradictions. They're not a form of cop-out. As I said, there's, in my mind, a big difference between expectations and a forecast. So an expectation is the anticipation of how things are likely to play out in the future based on my perspective of what I've experienced in the past, while forecasting is actually putting a time frame on that expectation. Of course, in an ideal world, it'd be great to be able to forecast what's ahead and then you can time the market. That's fool's play. But we can't. There's just too many moving parts. So there's all those statistics that are easy to quantify, but it's hard to identify exactly how all those millions of strangers out there in Australia are going to respond to the same prevailing economic and political environment. So I expected a downturn to occur. I didn't know it was going to be COVID that would cause it. I expected my properties to have periods of vacancies or problems or not go up in value as much, but I didn't know exactly what. I knew my business would have challenges as well. So I've built financial buffers in place, something I learned in the first recession I went through. And I've fortunately didn't need to use them because the downturn of the pandemic didn't really occur. My properties weren't vacant. My business did do well and the property values increased. But I'm again moving into the next phase of the cycle with large financial buffers. I'm planning for the worst, but I'm an optimist, Pete. You know me, so I'm expecting the best.
You remind me a bit of those old Jim Rohn presentations when people used to say, what's ahead for the next decade? And he used to say, look, I'll give you the special insight. It's the same as the last decade, challenge mixed with opportunity, and a winter season followed by a summer season. I think it was timeless advice. And I think I can actually remember having these same conversations in 2011-12 when there was a downturn in the housing market, and yet as those household wealth figures showed, housing wealth and in fact Australian household wealth more than doubled over the 10 years to today. So I guess as Jim would no doubt say, challenge mixed with opportunity to be expected over the next 10 years as well. So in the current...
Well, interestingly, just to finish off on that, just recently our research department went back 42 years to look at what's happened to house values in all our capital cities. And during that time, we had the pandemic, we had the global financial crisis, we've had wars, we had APRA interfering, we've had multiple governments. And interestingly, Melbourne had the best compounding capital growth over the last 42 years. It was just over 8%. Now, sure, there were periods when the property market dropped. Just go back to 2017 and Sydney and Melbourne prices dropped for a short time by 10%. But over the last 40 years, property values have gone up 540-something%. So you shouldn't think about the 10 or 15 or 5% the property values are going to fall. That's not the figure you should be concentrating on. You should be looking at the long-term growth that you've mentioned and I've mentioned before too. And interestingly, Sydney and Adelaide were just under Melbourne's growth, Brisbane a little bit less in compounding, but that's the whole market. And I think we've got to remember there isn't one Melbourne property market or one Sydney or one Adelaide market. So be selective within those markets and choose the right property for your budget and one that'll be in continuous strong demand by owner-occupiers. Forget tenants, even though you want tenants who are going to actually want to live in there as well. And you can't go wrong, Pete.
Yeah, so I guess to recap then, so we've got surging rents, construction costs have also surged a lot, which I guess underpins the price of new housing. But the economy is actually in a pretty good place. I think unemployment's at a 50-year low, and we've got record high job vacancies, so probably see unemployment falling towards 3%. So to sum up there, your property market strategy sounds like it hasn't changed a lot. Buy the right property in the right place in those landlocked suburbs where supply is constrained. Try and negotiate hard and buy below market value. But I guess you're focusing on those high land value assets where you've got potential to add value either now or sometime in the future.
Yes, I love to add value because you're not as dependent upon the market doing the heavy lifting. But again, it's demographic. So if you buy in the area where people have got higher than average disposable income for that state, then they're more likely to want to be able to afford to live there, or gentrifying suburbs that are changing in nature as well, where more affluent people are moving in. That's going to outperform the averages. So 2 years ago and last year, the markets everywhere did well, but now the markets are very much fragmented. But moving forward, even though we're not buying as many properties, people aren't selling as much, people are still going to get married, they're going to get divorced, they're going to have babies, or maybe not that order, but basically life's going to go on. There are still going to be discretionary sellers, people who have to sell. So if your finance is right and it's okay for you to do it, then you should look at buying property, not to take advantage of those people who have to sell, but to take advantage of the opportunities. When you look back, you'll think, hey, that was a good buy when you look back in 5 years' time.
Yeah, I guess there won't be too many forced sellers this time around. 3% unemployment and a job for everyone who wants one. I guess there might be some people who are spooked by the media commentary and become sellers in a panic, but probably not so many forced sellers.
Not mortgage stress. No, there won't be the mortgage stress, but it's because of circumstances. Life circumstances are going to dictate that people still have to sell properties. Sure.
Yeah, life gets in the way. So, Michael, thanks so much for all of your experience commentary there. And the 1970s, as you said, was a decade where we saw rocketing inflation, but actually for all of the challenges, the ups and the downs in the economy, the housing market produced some fairly spectacular results actually over the decade. So thank you again. And where can people go to if they want to listen to your podcast or find out more about Metropole and so on?
Well, the Michael Yardney podcast, wherever you're listening to this podcast, and you're a regular on that as well. So I give my thoughts on property investment, finance and money. And my team at Metropole help our clients grow, protect and pass on their wealth by giving strategic property advice, metropole.com.au, Pete.
Thanks, Michael. It's 27 degrees in Noosa this week, so we'll send our thoughts and prayers down to Melbourne, where it's probably more like 7. So, but I'm definitely due a visit, so hopefully we'll catch up for a coffee down in Melbourne soon.
Look forward to seeing you soon, Pete. Thank you.
Cheers.
Thanks for listening to Pete's Property Podcast, powered by Buyers. Don't forget to subscribe and join us next time as Pete chats all things property with a new guest. And just a reminder that the information provided in this podcast is general advice only and doesn't take into account your personal financial situation or needs. You should always consult a licensed professional to discuss your individual personal circumstances.